This is Brian Decker with your Market Minute. Want to cover probably one of the most important market minutes I've ever done, ever. How's that for a superlative? It talks about the debt that we have. It took more than 246 years to print the first $10 trillion in our deficit. Since 2020, we printed another 10 trillion. On March 5th, here's a possible brilliant solution. I don't know to call it brilliant, but it's a solution that has come up. And this was brand new information as of March 5th, just 4 weeks ago. On March 5th, the ISDA submitted a letter to the Board of Governors of the Federal Reserve, the FDIC, the Office of Comptroller of Currency to urge them all to implement targeted reforms to the Supplementary Leverage Ratio, the SLR, the enhanced SLR framework, and the risk-based surcharge for global bank holding companies that are important for preserving the resilience of the US Treasury markets, the US economy, and the financial system more broadly. The letter asserted that to facilitate the bank's participation in US Treasury markets, including clearing US Treasury security transactions for clients, the agency should revise the SLR to permanently exclude on-balance sheet US Treasuries from total leverage exposure, consistent with the scope of the temporary exclusion for US Treasuries that the agencies implemented in 2020. What does that mean? Essentially, the banks are asking for a permanent exemption to the SLR, which would give them the ability to buy an unlimited amount of treasuries with no capital requirements. Banks then would be able to borrow at roughly zero and earn 5.25% in short-term treasuries and 4.35 in long-duration treasuries. How much do you think you could earn on that spread? Further, existing treasury positions would be excluded from the SLR, giving banks more room to leverage up their balance sheets even further. This would be QE initiated by the banks. Can you imagine the amount of liquidity that is injected into the system? And here's the key. Theoretically, this move alone could fund the government indefinitely. I've been saying a long time that authorities would choose to kick the can down the road with the easiest path to solve the debt problems, and this looks like it's it. So let's watch this very carefully and see what more information comes out. If this is the route that we go in the next 40 years in the markets, it's not going to be equities, it's going to be commodities. This will be fascinating to watch.